David Stewart from Straight Talk Wealth Management, my Monday musings for the 31st of August. Thinking about, does inflation count? Many of us do not think about the difference between saving and investment. In simple terms, saving is usually putting money aside for a future purchase, such as a car or a holiday. Investing is putting money aside for your future. This would normally be for a longer term project, such as retirement, and would demand a greater potential for a real return. Bearing this in mind, I spent a happy few minutes looking at the rates being offered on easy access savings accounts and failed to find one that comes anywhere near matching the inflation rate, which does of course mean in real terms you're losing money. The best offer at the moment is Tandem, who are leading the way with a whole 0.65%. The same problem applies to term and notice accounts. The best notice account at the moment is with Oak North Bank, who you've probably never heard of, which is offering 1% on their 120 days notice account. If you're prepared to tie your cash up for 3 years, you can get 1.57% from Zopa, who again, you've probably never heard of. If you think about instant access cash ISAs, the best rate around is again from Synergy Bank, who you've probably never heard of, who will offer you a really thrilling 0.65%. Oak North Bank come back in with their 2-year fixed term ISA with a whole 1.02%. Now bear in mind these are the best rates available at the moment. If you think of where inflation's running, on any of these you're actually losing money. There are a couple of things that I really do fail to understand. The first, if you have an annual savings tax allowance of £1,000, which means you'd have to invest over 150,000 at 0.65% before you'd be liable for tax on the interest, why waste your annual ISA allowance of 20,000? Surely you'd be better off just leaving the money in a normal account and using your savings tax allowance. You should then take out a stocks and shares ISA, making sure it's at the right level of risk, which could be invested for you on a longer term project, and should at least beat inflation. Let me touch briefly on premium bonds. Whereas in the 90s the prize rate was 5.2%, it's now 1%. In simple terms, this means that if you invested 10,000 back in the 90s, you could expect to receive £520 per annum. Today, you should expect to receive £100. Makes no sense to me. Of course, there's no doubt that all of the above have their place in any portfolio, but in my view, only for the funds that you might need quickly for a purchase, or as your rainy day money. If you want to actually make money, you should really consider asset-backed investments. But before you make that investment, you should talk to an IFA to make sure that whatever investments you make that are asset-backed truly match the level of risk you're prepared to take. So once again, thank you very much for listening. We will of course be talking to you again next week. If in the meantime you'd like to see how the markets have performed, please do go to our website, and I look forward to seeing you again in a week's time.